How the U.S. plans to inflate its debt away, and how you can too. The United States government currently holds over $34 trillion in debt, with an annual debt servicing cost of $1.2 trillion. This means that every year, the government spends $1.2 trillion just to pay the interest on its debt. To sustain this, the government has to borrow more debt, leading to an endless cycle of increasing debt. However, there is a strategy that the U.S. government plans to use to inflate its debt away, and you can also apply this strategy to your own finances. Understanding the debt cycle. To comprehend how the U.S. government plans to handle its debt, we can look at historical patterns. The debt cycle can be divided into two phases, deleveraging and leveraging. From the 1940s to the 1980s, the government deleveraged its debt compared to GDP through inflation. During this period, inflation and interest rates were rising, and the government managed to decrease its debt burden. However, from the 1980s to the present, the government increased its leverage while experiencing disinflation and falling interest rates. This allowed the government to accumulate more debt at a lower cost. Currently, the debt-to-GDP ratio is around 120%, indicating that the government has reached its peak leverage and is likely to enter another deleveraging phase. The government's strategy. To tackle its debt burden, the U.S. government is expected to employ the following strategies. 1. Keeping interest rates higher. The Federal Reserve will likely maintain higher interest rates to combat inflation. This will result in increased borrowing costs for the government and the general public. 2. Returning to quantitative easing, QE. The Federal Reserve may resume QE, which involves buying government bonds to inject money into the economy. This will allow the government to borrow more money at lower interest rates, effectively monetizing a significant portion of its debt. 3. Slowing quantitative tightening, QT. The government will slow down the pace of QT, which involves repaying debt to the Federal Reserve. By reducing the repayment of debt, the government can continue borrowing to finance its spending. 4. Inflationary boom and deleveraging. The government's actions are likely to result in a period of inflationary growth. As prices rise, tax revenue will increase, allowing the government to pay off its debt. However, the increased debt costs may outweigh the additional tax revenue, leading to a potential inflationary boom followed by deleveraging. Applying the strategy to personal finances. Individuals can also adopt a similar strategy to protect and grow their wealth. 1. Increase personal income. Seek opportunities to increase your income, such as pursuing sales positions or starting a business. Sales positions are particularly beneficial during inflationary periods, as rising prices can lead to higher commissions. 2. Eliminate adjustable rate debt. In an inflationary environment, adjustable rate debt can be detrimental. Pay off or refinance any adjustable rate debt to avoid potential bankruptcy. 3. Use fixed rate debt to buy assets. Utilize fixed rate debt to purchase assets that appreciate with inflation. This strategy allows you to benefit from rising asset prices while paying off debt with devalued currency. 4. Diversify wealth. Protect your wealth by diversifying outside the traditional financial system. Consider investing in alternative assets like precious metals, real estate, or cryptocurrencies. Conclusion. The U.S. government plans to inflate its debt away by implementing strategies such as keeping interest rates higher, resuming quantitative easing, and slowing quantitative tightening. By understanding this strategy, individuals can apply similar principles to their personal finances. Increasing personal income, eliminating adjustable rate debt, using fixed rate debt to buy appreciating assets, and diversifying wealth can help individuals protect and grow their wealth in an inflationary environment.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.